A spreadsheet can tell you how a deal should look on day one, but it's completely silent on how it actually feels on day 700. And if you're still waiting for a static model to tell you when to pull the trigger, you're acting as an analyst, not an operator. And here's the truth about 2026. The profit isn't in the purchase price anymore, it's in the precision of the hold. If you're here, I'm guessing this isn't your first rodeo. You've closed a few deals, you know what a cap rate is, you understand DSCR, you felt the heat of a closing table. You're not here to learn how to underwrite a property. You're here because you realize something. That best case scenario in your model, it rarely survives the first quarter of operations. The basics are just entry fee now. The real wealth or real carnage happens in the technical nuances of the mid-hold pivot. I recently watched a breakdown by Breaking the CRE on the new rules for multifamily underwriting in 2026. Excellent work. Necessary work. It covers the foundational shifts, negative rent growth, and oversupplied Sunbelt markets, the topping out of the American renter, shifting property tax dynamics. And if you're trying to get a deal past an investment committee or lender today, you need that foundation. You have to know how to adjust your exit cap rate assumptions, how to bake in 12 to 18 months of flat revenue. But if you're sitting on 50, 100, 500 units, that video is just the beginning. It tells you how to get the car into the race. It doesn't tell you how to keep the engine from blowing up when the track conditions change at lap 50. Here's where we stand. The easy money assumptions of 2021 are dead. We're underwriting for flat or negative near-term growth because we're finally hit the supply wall. Renovation premiums are tighter because the consumer's wallet is maxed out, and we're modeling downside sensitivity again. What happens when the market goes sideways, not just up? On paper, the industry got conservative again. Models look safe, but safe on a spreadsheet and secure in the real world, two completely different things. Here's what the model doesn't see. The model treats a 2% rent drop as a line item reduction, clean, simple. But in the real world, a 2% rent drop isn't just a number, it's a signal that your entire leasing strategy needs to be re-engineered. What breaks deals in 26 isn't a missed decimal point in your pro forma, it's an inability to manage operational friction. When your top line growth stalls, every single inefficiency in your management stack gets magnified. The model doesn't account for a psychological shift of your on-site team. They're no longer order takers during the boom. They're now fighting for every renewal against a brand new merchant build down the street, offering 3 months free rent. The spreadsheet assumes your expenses follow a predictable 3% inflation curve, but it doesn't model the supply side shock to your labor costs. It doesn't model the fact that your value add renovation might take twice as long because your subs are distracted by larger developments. This is where real money is made and the gap between the static assumption and the dynamic reality. Let's get into what actually moves the needle right now. Three things: lease laddering, revenue illusion, and capital duration. So the hidden risk of lease laddering, most analysts look at an average rent drop and adjust to a market rent column. That's amateur hour. As an operator, you need surgical precision on your expiration schedule. Why? Because in high supply environment, vacancy is contagious. Let me paint a picture. You have 30% of your leases turning over in Q2. It's the same quarter a 300 unit Class A wrap down the street is in their lease up or die phase. That developer, they're going to drop the hammer on concessions to satisfy their brave lender, and they will cannibalize your tenant base. Your model 2% rent drop, fantasy. Your vacancy will spike, your DSCR will dip, and you'll find yourself in a technical default despite having a conservative model. What do? We manage lease expirations to ensure we're not fighting the supply monster all at once. We offer 10-month or 14-month leases to smooth that curve, even if it costs us short term. Basis protection starts with expiration management, revenue illusion versus expense creep. The new rules video correctly points out that property tax resets might provide a tailwind. That's a gift, but it's also a trap. Don't let a lower tax bill mask a deteriorating other income line. The American renter in 2026 is cost burdened. When a tenant is choosing between groceries and pet rent, the pet rent disappears. When they're choosing between the electric bill and the late fee, they stop paying the late fee and dare you to evict them in tenant-friendly court. Your RUBS income, your parking fees, your admin charges, these are the first things to erode when the consumer tops out. And here's the question. If your conservative model relies on these ancillary income streams to hit your IRR, what happens when they vanish? You're in trouble. An experienced operator knows at a down cycle, you find invisible efficiencies. You're not just cutting the landscaping budget, you're auditing water usage, renegotiating trash contracts, looking at your payroll to unit ratio. You earn your margin in the white space, the P&L, that analysts never even look at. Capital stack fragility and the refinance gap. Let's talk about debt. Everyone's excited because the SOFR is trending down. Floating rate debt looks attractive on paper, but here's your operator's nightmare: the refinance gap. See, the new rules suggest you can model a 5-year hold, But what if market absorption of all new year supply takes 7 years to the five? Do you have the capital duration to survive? A floating rate loan with a 3-year term and 2 1-year extensions sounds great until your cap is expiring and the cost to replace it has tripled because volatility spiked. Real money is made by the guys who can outlast the cycle. And if you don't have the equity relationships to recapitalize or the debt structure to wait out the supply glut, you're just a temporary steward of the asset for a person who will buy it from your lender. We're not just underwriting the asset anymore, we're underwriting our own ability to stay in the game. At this level of the game, we're not just buying apartments, we're managing capital through time. Anyone can hire an analyst to build a beautiful Excel model showing 15% IRR, but as a portfolio owner, the technical skill of underwriting is just lap one. Lap two is a 3-year grind. It's a Tuesday morning meeting where you decide drop rents by $50 or increase marketing spend by $10,000. It's realizing your basis protection isn't found in your formula, it's in your operational grit. We're not looking for deals anymore. We're looking for positions we can defend and scale. This channel isn't for people who want to learn how to color code a spreadsheet. It's for people who are actually signing personal guarantees. Managing the property managers trying to figure out how to grow a portfolio when the easy days of 2021 are a distant memory. We think full life cycles, not just acquisition fees. Underwriting gets you into the asset, but operational discipline decides whether you keep it, whether you have the strength to scale it from. The new rules of 26 aren't just about changing your assumptions, they're about changing your mindset from a buyer to a steward. And here's what I need you to understand. If you're still thinking like a buyer, you're going to get eaten by someone who thinks like a steward. That's where the game is played now. Not on the spreadsheets, but in real time, with real risk, with real consequences. The spreadsheet is the map, the operation is the journey. And all the people who survive this cycle, they're the ones who stop asking, how do I get in? And started asking, how do I outlast? Stay disciplined. I'll see you in the next one.